Hey, Mike Swanster. I want to do an educational video with you this weekend because there are patterns that are going on in markets all over the world. Stage 3 tops and Stage 4 bear markets are dominating markets everywhere. But it's happening with many sectors now inside the United States. And this is about how market cycles work. So, in a stage 2 bull market, you have a market that's making higher highs and higher lows consistently. And during those markets, the 150 and the 200-day moving averages act as a price support level. When the market falls to that, or sector or stock, whatever the case is, that becomes a buying point repeatedly. And most bull market cycles last between 3 to 5 years. Now, the U.S. stock market cycle has it bottomed in 2009, so this has been one of the longest cycles in stock market history. In fact, I don't think there's been one longer than this in well over 100 years. And that's why right now there's hardly anything in stage 1 or starting stage 2. To find those candidates, you have to look outside of stocks. You have to look at commodities and in places like that. So most things are late in stage 2, or in stage 3, or in stage 4, across the board in sectors and markets all over the world. So let me give you an example of how this works. Stage 3 tops happen in the points I've circled on this chart. There's one in the summer of 2000. This is the S&P 500. In 2007, there was one also that started in July, ended in October, and everything rolled over. During those times, the moving averages tend to flatten out, and there's some volatility that often increases in the markets towards the end of this stage 3 top. But there will be a support level that's formed, and then when the market cracks and rolls over, the decline will intensify. The moving averages become kind of far away from the price. Price declines below the moving average and extends below it. Those moving averages act as resistance, and you're in a classic stage 4 bear market at that point. Now, I've got two squares on the chart in 2002 to 2003 and in 2009. Those are the stage 1 basing patterns in this market. But I'm not going to spend a lot of time talking about that, so I want to talk about what's going on with the financial markets and the sectors. Now, in 2015, there were signs that a stage 3 top was happening, and we got a 20% drop actually in the S&P 500 that very easily could have led to bigger declines, but central banks intervened around the world. They increased their quantitative easing programs, and I think they saved the day. But now we have what I believe are signs of a classic stage 3 top in the stock market going on right now. Now, I'm not going to do a video going through all those signs right now. I just want to get this basic concept of these stages in your mind and show you some examples of where we actually are seeing a transition from stage 3 into stage 4, or it's already happened. So this is FXI. It's an ETF for China, and China made a peak in January, just as the U.S. stock market made a peak in the Dow and the S&P and the NASDAQ, and pulled back. China pulled back, but it didn't bounce back up like the NASDAQ did, and instead it went sideways with a support level on this ETF at approximately $45. That support level cracked in June, and the price of XI plunged and diverged away from the 200-day and the 150-day moving averages, which are the green line in the charts. The 200, the red line, is the 150, and we diverged away from that, and we've been below it now for almost 3 months. So those moving averages are now going to act as resistance. The trend is now down in China in the FXI ETF, and I would expect as the rest of the year goes on, we're going to see more selling here because we're in a bear market. And when you're in a bear market, you've got to expect the market to make lower highs and lower lows because that's how the trend works until the trend ends. And since this just started a few months ago, it's likely to last for the rest of the year, if not beyond. So when we look at this, we can see, yes, there was a stage 3 top in FXI that was completed this June when the support level in FXI was broken. And it's very important to understand when this happens because it means that investing in this is a losing proposition because you're at the very beginning of a bear market. That's exactly the worst time to invest unless you happen to invest at the exact top in January. You don't want to invest at the very start of a bear market. You want to, the best time to invest is at the beginning of a bull market or the beginning or the end of the stage 1 consolidation phase. So you got to avoid China. But the problem is this type of action is now happening with many individual stocks inside the U.S. stock market that they're breaking down, they're going through the moving averages and falling well through them. And now they're in bear markets. Even though the NASDAQ is still above the 200-day moving average and the S&P and the Dow are, many sectors and many stocks that make up the U.S. stock market are now in bear markets. And it's a very dangerous situation. So here's something that is just in the transition of going into a bear market. It really started this week, and that's the casino gaming sector. What we have witnessed this year is a stage 3 top. This is BJK, the exchange traded fund for the sector. Now it's hanging on recent support around $44. That was the low of July. But really, $45 was the support level in June, in April, and so forth. We're below that level, but a lot of people can look at this chart and have hope. Maybe we can hold that July low and bounce back up. Okay, well, if we go below it, that July low, down to 43 or something, it's completely breaking down. And that means this is going into a vicious bear market. It's starting a bear market right now. It's a critical transition moment. And these critical transition moments only come every couple years in a sector, in an ETF, in a stock, and much less the entire stock market. But when they happen in multiple sectors, and it spreads throughout the market, then it carries over into the stock market averages. It hasn't happened yet, but it's happening enough that it's got to get our attention, and it's one of the reasons I think we're really in a stage 3 with the S&P and the Dow and the NASDAQ, but that will play out over the coming weeks if I'm correct about that. What's more important, though, is this sector. And the other examples, they're lessons to help us understand how these concepts play out in real time. And I didn't put the stocks that are the leader stocks in the gaming sector, but they have broken down substantially. They look a lot worse, in fact, than this exchange-traded fund. Wynn had a huge drop last week. MGM had a huge drop last week, and so did many of the other casino stocks. And that's why I think they're in the leaders are breaking down. This ETF is doing a little bit better, but I just think that's a temporary condition, and it's going to get drugged down too. But this is not the only sector that's in a potential pivot point in the U.S. stock market. Another sector that is in a very troubling position is the Homebuilder Sector. So it peaked out in January just like the Dow did, got slammed just like the Dow did, but while the NASDAQ rallied back up to a new high, and the S&P and the Dow bounced, this sector really did not bounce at all. It simply went sideways for the past couple months, and it has a support level around 39. It's above 39 right now, but if it closes and falls below, let's say 38.50, if it gets down to 38, it will be breaking the summer support and it'll be telling us, look, this is a serious bear market that is just starting now in this sector. And that's a critical thing to know. If you can pinpoint, when a bear market starts, like within 90 days, if you can spot that 90-day period in a bear market that could last for years and take action on that, that's huge. So if you want to bet against stocks right now, the casino sector is a place to look. The homebuilder sector is a place to look too. And the reality is many of the leading homebuilder stocks have already broken down, just like the casino stocks have. These two sectors are now among the worst performing sectors of the year so far, even though they were among some of the best performing sectors since the day Donald Trump got elected up to this January. So that's a big change going on with these sectors. And as I said, many of the leading stocks in this home builder sector are also dumping. To give you, if you want to go look for yourself, take a look at Beazer Homes, symbol BZH, and you'll see exactly what I'm talking about. So I don't really want to spend a lot of time talking about the broad stock market, but as you see, here's the Dow. It's got support at 23,500. So we can now debate, is this a stage 3 top? If it is a stage 3 top, then before the end of the year, we're going to see the Dow close below 23,500, and if it does that, it's going to be telling us that it's going into a new bear market, and we'll have to be very cognizant of that fact and recognize it and adjust and adapt to it. Now, I think it's a stage 3 top, okay, and I'm already acting on that with some of my money. But a lot of people don't believe that. A lot of people disagree. You may disagree. And if this is not a stage 3 top, then this is simply a consolidation phase in the markets that's probably going to last longer because we've seen a lot of stocks get hit hard over the past couple weeks. I know Apple went up a lot last week, but a lot of the technology stocks got slammed. And there's a lot of weakness in the stock market inside of it, which suggests that, if there's really not much upside, let's say, for the short term. So if this is simply a consolidation pause, it's going to lead to bigger gains later, then that's what the story is going to be. More sideways action, maybe and then whatever. But remember this 23,500 level because when things break critical support levels, they fall. And China did it. Many global markets did it. The emerging markets did it also this June. So there's lots of warning signs out there. And when markets are in a period of transition, it's really important to understand how trends work. And keep your eyes open to what is going on. And stage analysis is a methodology that we are going to use to keep on top of what's going on and make sure we understand what's going on and don't miss critical market turning points when they happen, because they're happening right now in casino stocks. They really appear to be on the verge of happening with the home builder stocks too. Really, they have. It's just the ETF has managed to hold up. So be talking with you later.